Good morning. Good afternoon. I don't know. It's 7:30 for me here. So good morning, good afternoon, whatever time of day or night that you're hailing from. So I want to talk about Lou's video that has a lot of people up in arms. Uh, if you're not familiar with it, I'll link it, and you can come to your own conclusions. Um, I'm not a big fan of what he was saying, and I wish I could give the benefit of the doubt and assume that maybe there was some misarticulation or just a misunderstanding, but I can't. I can't. It's just not. Bro, come on. Okay, so listen. I don't think there was any uh, bad intent with it, and I also want to say, just because somebody fucks up once doesn't mean that everything that they have said and say going forward is invalidated by default. And inversely, just because someone gets something right once doesn't mean that they're forever right and have always been right. But this was a little too much. Okay, so my hyperbolic reaction aside, I don't agree at all, and just to say to not buy as a means to support whatever narrative or notion, it just doesn't. No, it just doesn't work. So I want to go over why, and I do want to mention something that's extremely important. Um, what Lou was getting at is by removing the entropy, or just the activity, that it will remove the ability for synthetic shares and rollover settlements and whatever, right? This will happen regardless. And to say to stop buying a stock is not a good idea, because what then happens is you have a liquidity crunch on the demand side, relatively speaking, right? For whatever, this isn't in absolute terms, but in general, if people were to stop buying at whatever rate that the stock typically goes through, uh, you're now forcing someone on the other side of the trade to cross the line, to cross the bid ask, which would drive the price down. There is a lack of demand, and if somebody is trying to get this off their hands, they will uh, literally sell themselves short, potentially, but they will be willing to sell for less, and that removes value. Also, with the ideas of the IOUs, and there are very few instances that this takes place in an organic setting where there is a problem. These IOUs, market makers will sell shares they don't have, but that duration of lack of ownership is milliseconds. They will source the share. They'll take the trade, right, and sell a short, right, with intent to locate if they don't already have one, and then fulfill it and hope that the delta between selling short and sourcing, that you eventually can either profit from it or at least come out even, right? It's milliseconds. We're talking high frequency trading and algorithmic trading. So there's very little downtime between these two activities. The IOUs persisting for as long um, as tons of intervals. There's T+3 uh, uh, as far as being a market maker goes. There's also T+6 with bona fide market making activity. And then you can have all the way up to T+35, which I've gone over quite a bit here. Regardless, though, the idea is, I think, very shallow and naive, which is sad because Lou is a seemingly smart guy. I don't agree with everything he says, and there's a lot of speculation as to who and what he is. I'm just worried about the information, so I don't want to get personal about it. I don't want to dive into that. All things considered, not a very good consensus from him. What I do want to talk about, though, is, and this is what we're currently witnessing, uh, as what would be also a byproduct of not buying, which is lower volume, right? And this happens on both sides, whether it's on the bid side, so buying, or the ask. And the difference between these two is what dictates your price, right? If someone is willing to, I don't know, if we're at $1 and a penny here and $1.02 over here, someone's got to cross. Someone has to either buy at 102 or sell at 101. And this is ultimately what drives markets. This drives every transaction that takes place, even outside of markets. The problem with discontinuing or not buying is that now you have less of this and the same amount as this, which relatively speaking means that there is now more and less. In realistic terms, you are now creating a liquidity crunch on the demand side. So the ask, the person selling, will probably cross the line, right? They will cross the bid-ask spread. And for this, the new price becomes 101. And then rinse and repeat. And this is what creates downward pressure. So now let's dive even further into this. I imagine this would be a byproduct of this idea of everybody just not buying, which is, forget that even, just forget that. Let's talk about what is happening in realistic terms that we're witnessing every day, which is volume going down. You can see it down here. Hopefully that's clear enough. And this is actually extremely good. And there are plenty of technical reasons why. But I want to talk about something more technical, which is days to cover. All right, days to cover, or DTC, literally means days to cover. It's a metric of how many days it would take for someone to theoretically cover a short position. In general terms, this is of anyone with short interest being registered. And I get it. You know, a lot of this data, if not all of it, is self-reported. The data isn't what we all wish it would be, especially as far as accuracy and integrity goes. But I and we are worried about the behavior of the data, right? If we can see how it is acting and draw conclusions based off of that, we can start to paint a picture. So days to cover is equal to your total short interest, or SI, divided by your average daily trading volume. All right, typically this is over the span of 30 days, sometimes it's 10 days. Depending on who is putting together this metric, everyone has their own assessment of what a accurate sampling period is. So ultimately you output a days to cover, right? So your metric is days, this is time. This makes a lot of sense because if you have a short interest of 100 shares, right? If there's 100 shares that are registered short and your average volume is 50 shares a day, 100 divided by 50 equals 2 days to cover. So hypothetically, right, and I don't agree with this metric all that much, but as far as the industry goes, I guess it can make a lot of sense. It would take someone or someone's 2 days to exit a short position. Anytime this is over 1, this spells really bad news for whoever has a short position, because you will find that institutions will intentionally target stocks that have a days to cover greater than 1, because when you're operating at this level of your wholesaling inventory, when you have a presence that is big enough that you can move markets and you can move charts, this actually becomes extremely important, because if you need to offload this from your books, right? If it takes 2 days to do that, or it takes 1.01 days to do that, that's not good. That's literally what it comes out to. To create a transaction, to get out of all of your short interest, it would take more than 1 day to do so. It would take more than 1 trading session, which is not good. And with the way that volume has been, we actually see days to cover going up considerably. Hopefully you can see this all right. So I'm looking right over here under this DTC column. The most recent days to cover report, and this happens every 2 weeks from the FINRA SI publication. The most recent comes out to 2 days and 7/100ths, right? 2.07 days. Before that, it was 2.6, 2.2, 1.6. Now, what you'll see a lot of the time is actually that it comes out to exactly 1, which is to me pretty. No, not even. It is very interesting to me that a metric like this can be navigated in such a way that it comes out to exactly 1. What this means is that you have 2 sides of this, right? Where's my goddamn whiteboard? Okay, you got 2 sides to this. So days to cover, your days to cover is equal to SI over average volume, right? So I know this seems way too redundant, but just follow me here. So you have volume and average volume, or rather you have a share count and an average volume. So these 2 factors are the only things that can be manipulated or changed, right? And I don't mean any nefarious connotation with the word manipulated. So which of these would be cheaper to compensate for so that you come out to 1 day to cover? Is it your short interest or is it your average volume? Well, how do you manage that? Well, if you're a market maker, depending on the total outlook of the market, this is seemingly easier to handle. If you just wholesale blocks at a time and manage to navigate that buying and selling pressure in such a way that it doesn't peak over the total short interest, or you maneuver it so that it doesn't exceed 1 day to cover. Let's say we're at 100 shares with a short interest, and someone wants to make sure that there is 101 shares being traded every day across 30 days. It's a teeter-totter, right? The things you would play on as a kid. It goes this way, and like you have short interest on this side, and then you have average volume on this side, and depending on which is cheaper or has some business-related incentive to it. I don't know. It's really interesting to me, and not many people talk about it, especially to this degree. It's such a simple metric, and a lot of people overlook it and forget about it altogether. So this is something to really think about. Which is easier to modify, or to modify the behavior of in such a way that you get 1 day to cover? Because otherwise, if this is greater than 1, it equals trouble. Right? So some food for thought. I'll probably make another video diving more into this, but for what it's worth, that's the takeaway. So if you enjoyed it, leave a like. If you didn't, whatever, go fuck myself. See ya.